Imagine standing at the edge of a vast financial landscape, where opportunities and pitfalls coexist, and every decision can shape your future wealth. This is the world of investing, a world filled with excitement but also with risk. How do you navigate it wisely? How do you ensure that every step you take brings you closer to financial security rather than uncertainty? The answer lies in timeless wisdom, tested strategies, and an unshakable mindset, exactly what The Intelligent Investor by Benjamin Graham provides. Revered by financial experts and hailed as the Bible of investing, this book is more than just a guide, it is a philosophy. First published in 1949, The Intelligent Investor remains one of the most influential works on investing ever written. Its core principles have stood the test of time, shaping the investment strategies of countless successful investors, including Warren Buffett, who credits the book for laying the foundation of his own investment philosophy. At its heart, The Intelligent Investor introduces the concept of value investing, a strategy that emphasizes buying undervalued stocks with strong fundamentals and holding them for the long term. But this book is not just about picking stocks. It is about cultivating the mindset of an investor, understanding risk, and making rational decisions based on careful analysis rather than emotions or market speculation. Graham's approach is refreshingly simple yet deeply profound. He teaches us that the stock market is like a fickle business partner, sometimes euphoric, sometimes irrationally fearful. The intelligent investor learns to take advantage of these mood swings rather than be controlled by them. He introduces the concept of Mr. Market, an imaginary character who offers to buy or sell stocks every day at wildly fluctuating prices. A wise investor, rather than being swayed by Mr. Market's erratic behavior, calmly assesses opportunities and acts only when the price is right. This audiobook summary will take you on a chapter-wise journey through Graham's investment philosophy, unraveling the wisdom hidden in each lesson and showing you how to apply it in today's financial markets. Whether you are a beginner seeking guidance or a seasoned investor looking to refine your strategy, Graham's insights will provide you with the tools and confidence to navigate the financial world with intelligence and discipline. Now, let's discover what it truly means to be an intelligent investor. Let's start with Chapter 1, Investment versus Speculation. Graham starts by drawing a clear distinction between investment and speculation. Investing is a disciplined approach to wealth building, one that involves thorough analysis, a focus on long-term value, and a critical concept he introduces called the margin of safety. The goal of investing is to protect and grow wealth gradually through careful selection and patience. Speculation, on the other hand, is more like gambling. It relies on market trends, emotions, and short-term price movements rather than intrinsic value. He cautions that many market participants believe they are investing when they are, in fact, speculating. Buying a stock simply because its price is going up, without considering its fundamental value, is speculation. Intelligent investors must cultivate a mindset of patience, rationality, and skepticism of market hype. Graham emphasizes that the key to long-term success is not chasing quick profits, but making decisions based on careful evaluation and a deep understanding of the businesses behind the stocks. One of Graham's most famous quotes is, "The intelligent investor is a realist who sells to optimists and buys from pessimists." This encapsulates the essence of disciplined investing, taking advantage of market overreactions instead of being swayed by them. Next is Chapter 2, The Investor and Inflation. In this chapter, Graham addresses a silent but powerful force that erodes wealth over time: inflation. Inflation is the gradual rise in prices of goods and services, reducing the purchasing power of money. While many investors focus solely on returns, Graham reminds us that real returns, adjusted for inflation, are what truly matter. He warns that inflation can diminish the value of fixed income investments like bonds and savings accounts. For instance, if inflation is 3% per year and your savings earn only 2% interest, your purchasing power is actually shrinking over time. This is why investors must seek out assets that have the potential to outpace inflation. Graham suggests that well-selected stocks, particularly those of companies with strong pricing power and sustainable business models, tend to be better long-term hedges against inflation compared to bonds. He also recommends a balanced approach, advocating for diversification between stocks, bonds, and other assets like real estate or commodities to mitigate inflation risks. A key takeaway here is that ignoring inflation when making investment decisions can lead to disappointing long-term results. Intelligent investors factor in inflation when assessing potential returns and portfolio allocation. Chapter 3 is A Century of Stock Market History. Graham takes us on a historical journey through the past 100 years of stock market trends, demonstrating how financial markets have evolved through periods of booms and crashes. The goal of this chapter is to show that while the stock market is unpredictable in the short term, it follows recognizable patterns over time. One of the key lessons from history is that markets go through cycles, periods of excessive optimism, bull markets, and excessive pessimism, bear markets. Investors who understand these cycles can avoid making impulsive decisions driven by short-term market sentiment. Graham highlights major financial events, including the Great Depression of 1929, post-war economic booms, and various stock market bubbles. He points out that excessive speculation often leads to financial crises. By studying past market movements, intelligent investors can recognize the warning signs of unsustainable price increases and avoid falling into the trap of herd mentality. A crucial takeaway from this chapter is that while past performance is not a perfect predictor of the future, understanding market history can help investors maintain a rational perspective during volatile periods. Graham advises investors to remain patient and disciplined, resisting the urge to follow the crowd during euphoric market phases and staying steady during downturns. Next is Chapter 4, The Defensive Investor's Approach. Benjamin Graham acknowledges that not every investor desires the thrill of stock picking or has the expertise to navigate market fluctuations actively. For those who seek a safer, more structured path, he introduces the concept of the defensive investor, one who prioritizes stability, predictability, and a steady accumulation of wealth. Unlike speculators or aggressive traders, the defensive investor adheres to a disciplined strategy, avoiding hasty decisions driven by market euphoria or panic. The essence of this approach lies in selecting investments that stand the test of time, emphasizing well-established companies with a history of strong financial health, consistent dividends, and resilience through economic cycles. Rather than chasing short-term gains, the defensive investor focuses on long-term growth by maintaining a balanced portfolio that is not overly exposed to market turbulence. Graham advocates for a combination of stocks and bonds, ensuring that the portfolio remains diversified and insulated from extreme downturns. He warns against the temptation of speculative investments, urging investors to resist fads, overpriced stocks, and companies with uncertain futures. In his view, simplicity and patience are the defensive investor's greatest allies. By adhering to a methodical, rules-based approach, one can weather financial storms and achieve sustained financial security without being swayed by the market's unpredictable mood swings. Chapter 5 tells about the enterprising investor strategy. While the defensive investor treads cautiously, the enterprising investor is one who dares to go beyond conventional wisdom, seeking superior returns through a combination of skill, research, and calculated risk-taking. However, Graham makes it clear that this path is not for the faint-hearted. It demands an analytical mindset, relentless discipline, and the ability to sift through the noise of the market to uncover true value. Unlike those who blindly chase trends or gamble on market momentum, the enterprising investor methodically searches for undervalued stocks, companies that are trading below their intrinsic worth due to temporary setbacks, market inefficiencies, or overlooked potential. For Graham, value investing is the enterprising investor's greatest weapon. Instead of focusing on hyped-up growth stocks with inflated valuations, he encourages investors to seek businesses with solid fundamentals that have been unfairly discounted by the market. This requires a keen eye for financial statements, an understanding of industry dynamics, and the patience to hold on to investments until their true worth is recognized. The enterprising investor is also opportunistic, paying close attention to special situations such as mergers, reorganizations, and distressed companies that offer hidden potential. But with this approach comes responsibility, emotional control, continuous learning, and a willingness to accept that not every investment will be a winner. In the end, Graham insists that success for the enterprising investor comes not from speculation, but from a well-thought-out strategy based on rational decision-making and long-term vision. Next is Chapter 6, Portfolio Policy for the Defensive Investor. Building upon his earlier insights, Graham delves deeper into the importance of portfolio construction for the defensive investor, emphasizing the need for balance, risk mitigation, and financial prudence. The cornerstone of his philosophy is the 50-50 rule, where an investor should ideally maintain an equal split between stocks and bonds. This allocation serves as a safeguard, ensuring that neither market booms nor downturns have an outsized impact on overall wealth. However, Graham acknowledges that flexibility is key. In times of economic uncertainty, shifting to a more conservative stance, perhaps 75% in bonds and 25% in stocks, can provide an extra layer of protection, while bullish markets may justify a heavier allocation to equities. Stock selection, in Graham's view, should be based on quality rather than speculation. Defensive investors should favor blue-chip companies with a strong track record of profitability, steady dividends, and a history of weathering economic downturns. These businesses, often leaders in their respective industries, offer reliable growth without the volatility associated with speculative investments. Bonds, on the other hand, serve as a stabilizing force, offering a predictable income stream and cushioning against market crashes. Graham advises investors to prioritize high-grade corporate or government bonds rather than riskier, lower-rated debt instruments. At the heart of this strategy lies the principle of discipline. Investors must resist the urge to make impulsive changes based on short-term market movements and instead adhere to a structured, long-term approach. Regular rebalancing ensures that the portfolio remains aligned with the intended risk profile, preventing emotional decision-making from derailing financial goals. By embracing this strategy, the defensive investor can achieve steady, sustainable wealth accumulation, avoiding the pitfalls of speculation and market hype. Chapter 7 is about portfolio policy for the enterprising investor, the positive side. Graham now shifts his focus to the enterprising investor's approach to portfolio policy, which is far more dynamic and hands-on compared to that of the defensive investor. Instead of adhering to a static allocation, the enterprising investor carefully selects securities based on market inefficiencies and intrinsic value. Graham encourages investors to seek out undervalued stocks, bonds, and even special situations such as arbitrage opportunities or distressed assets that have the potential for substantial returns. This method is not about reckless speculation but rather disciplined, research-driven decision-making that takes advantage of temporary mispricings in the market. The essence of this approach lies in being opportunistic while maintaining a rational outlook. The enterprising investor must be willing to conduct deep fundamental analysis, scrutinizing a company's financial statements, competitive position, and management quality. However, Graham warns against overconfidence and the illusion of control. Even the most diligent investor must accept that markets can behave unpredictably, and therefore, diversification and a margin of safety remain critical components of a successful portfolio policy. By exercising patience and maintaining a strong analytical foundation, enterprising investors can outperform the market over time, but only if they remain disciplined and resist the temptations of speculation. Next is Chapter 8, The Investor and Market Fluctuations. One of Graham's most powerful lessons in The Intelligent Investor revolves around understanding and mastering the emotional aspect of investing. In this chapter, he introduces the concept of Mr. Market, a fictional character who embodies the market's erratic behavior. Some days, Mr. Market is euphoric, offering outrageously high prices for stocks, while on other days, he is pessimistic, willing to sell at irrationally low prices. Graham's lesson is clear. Successful investors do not react emotionally to these fluctuations but instead use them to their advantage. The intelligent investor does not attempt to predict market movements or engage in frenetic trading based on short-term news. Instead, they recognize that market prices often diverge from the true intrinsic value of a business. When stock prices fall below their fundamental worth, it presents a buying opportunity. When they soar beyond reason, it may be time to sell or hold cautiously. This disciplined mindset shields investors from panic selling during downturns and irrational exuberance during bubbles. Graham urges investors to remain rational, to view stocks as pieces of real businesses rather than ticker symbols, and to rely on a well-researched valuation approach rather than the fickle emotions of the marketplace. Chapter 9 talks about investing in investment funds. Graham acknowledges that not all investors have the time or expertise to analyze individual stocks and bonds. For such investors, he discusses the role of investment funds, which pool resources to provide diversified exposure to the market. However, he is highly critical of actively managed funds that promise market-beating returns yet often fail to deliver over the long run. The problem, according to Graham, lies in high management fees, excessive trading, and the inability of fund managers to consistently outperform market indices. Instead, Graham advocates for a more passive approach. Investing in low-cost index funds that track the overall market. These funds eliminate the risks of poor stock selection and high turnover while ensuring that investors participate in long-term market growth. He warns against falling for flashy marketing campaigns or funds that boast short-term success, emphasizing that long-term consistency and cost efficiency are far more important. The key takeaway from this chapter is that while investment funds can be a useful tool for investors, one must carefully assess their fees, strategies, and performance relative to passive alternatives before making any commitments. Next is Chapter 10, The Investor and His Advisors. For investors who prefer professional guidance, Graham explores the role of financial advisors and stockbrokers. He cautions against blindly following advice from those who may have conflicts of interest, such as brokers who earn commissions on trades rather than prioritizing the investor's best interests. Many advisors claim to have predictive abilities about market movements, but Graham firmly believes that no one can consistently forecast stock prices with accuracy. Instead of seeking market predictions, he suggests that investors work with advisors who focus on sound investment principles, asset allocation, and risk management. Graham argues that a good investment advisor should act as a teacher, helping investors develop financial literacy rather than simply selling them products. He encourages investors to ask tough questions, demand transparency regarding fees, and avoid emotional decision-making influenced by advisors who may be more focused on their own profits than on client outcomes. The best approach, he concludes, is to take personal responsibility for one's investments, using professional advice as a tool for guidance rather than a crutch for decision-making. Chapter 11 talks about security analysis for the lay investor. Graham emphasizes that while professional security analysis can be complex, the lay investor can still apply fundamental principles to assess the financial health of a company. The key is to focus on objective data rather than speculation. Investors should examine financial statements, earnings history, and dividend records to determine whether a company is financially sound. Graham introduces the concept of intrinsic value, which is the true worth of a business based on its financial health rather than its market price. He warns against relying too heavily on market sentiment or analyst predictions, which can often be misleading. Instead, investors should focus on companies with strong balance sheets, reasonable price-to-earnings (PE) ratios, and a history of steady growth. Graham encourages a margin of safety, buying stocks at a discount to their intrinsic value, to protect against market downturns. This chapter serves as an introduction to value investing, giving lay investors a structured approach to identifying fundamentally strong businesses while avoiding speculative pitfalls. Next is Chapter 12, Things to Consider about Per Share Earnings. Investors often place heavy importance on earnings per share, EPS, when evaluating stocks, but Graham urges caution in interpreting these figures. EPS can be misleading due to accounting practices, changes in tax regulations, or temporary fluctuations in revenue. Companies can manipulate earnings through stock buybacks, adjustments to depreciation methods, or creative accounting, making it crucial for investors to look beyond surface-level numbers. Graham recommends focusing on long-term earnings stability rather than short-term fluctuations. Instead of relying solely on EPS, he advises investors to examine the company's broader financial history, looking at trends in revenue, debt levels, and profitability over a decade or more. He also highlights the importance of consistency. Companies with erratic earnings growth are riskier, whereas those with steady, reliable profits are more likely to offer sustainable long-term returns. This chapter teaches investors to be skeptical of exaggerated earnings reports and to adopt a more holistic approach to evaluating corporate performance. Next is Chapter 13, a comparison of 4 listed companies. Graham brings theory into practice by comparing 4 publicly traded companies, illustrating how an investor can differentiate between strong and weak businesses based on fundamental analysis. He presents real-world examples of companies with different financial structures, market behaviors, and earnings histories, allowing investors to see how his principles apply in actual investment decisions. In this analysis, Graham highlights the importance of financial strength, stability, and valuation metrics. He compares companies with steady earnings and reasonable stock prices to those with erratic earnings or overpriced shares, demonstrating how intrinsic value should guide investment decisions rather than market hype. This practical exercise reinforces the principles discussed in earlier chapters, showing that investors who conduct thorough analysis can identify opportunities while avoiding companies that are trading at unjustified premiums. Next is Chapter 14, Stock Selection for the Defensive Investor. Graham believes that a defensive investor should focus on safety and steady returns rather than chasing speculative gains. The best way to achieve this is by selecting stocks of well-established, financially sound companies that have proven their resilience over time. He emphasizes that size matters. Larger companies with strong market positions tend to be more stable and resistant to economic downturns. These firms, backed by years of solid operations, provide a level of predictability that smaller, more volatile businesses often lack. Financial health is another cornerstone of defensive investing. Companies with strong balance sheets, low debt levels, and sufficient working capital are less likely to face financial distress. Graham stresses the importance of earnings stability, advising investors to seek out businesses that have been consistently profitable for at least a decade. A history of regular dividend payments is another reassuring sign, demonstrating that a company not only generates profits but also prioritizes returning value to its shareholders. The valuation of a stock plays a crucial role in determining whether it is a wise investment. Graham warns against paying excessive prices for stocks, as overvaluation increases the risk of losses. Instead, he recommends focusing on companies with reasonable price-to-earnings ratios and moderate price-to-book values, ensuring that investors do not overpay for future growth potential. By sticking to these fundamental principles, a defensive investor can construct a well-diversified portfolio that stands the test of time, avoiding unnecessary risk while benefiting from the long-term growth of stable enterprises. Next is Chapter 15, Stock Selection for the Enterprising Investor. For enterprising investors willing to take a more active role in their investments, Graham outlines a methodical approach to stock selection that balances risk with reward. Unlike the defensive investor, who prioritizes safety and stability, the enterprising investor seeks to capitalize on undervalued stocks through rigorous analysis and strategic decision-making. Graham stresses that the key to success lies in identifying companies that the market has temporarily undervalued due to irrational pessimism or short-term difficulties. He suggests looking for companies with low price-to-earnings (PE) ratios, strong financial health, and a track record of consistent earnings growth. Special attention should be given to smaller companies that are financially sound but overlooked by institutional investors. Additionally, Graham highlights the importance of buying stocks with a margin of safety, paying a price that is significantly below the company's intrinsic value to reduce downside risk. He warns against chasing trends, urging investors to stick to a disciplined, research-driven approach rather than emotional decision-making. By following these principles, enterprising investors can uncover hidden opportunities in the market while minimizing the risks of speculation. Next is Chapter 16, Convertible Issues and Warrants. In this chapter, Graham discusses convertible bonds and stock warrants, two financial instruments that offer unique advantages and risks. Convertibles are bonds that can be converted into a predetermined number of common stock shares, providing the investor with the stability of a bond while retaining the potential for stock appreciation. This hybrid nature makes convertibles attractive, particularly in bullish markets, where they can benefit from rising stock prices while offering downside protection through fixed income payments. However, Graham warns that convertibles can sometimes be overvalued, leading investors to pay too much for the stock conversion privilege. He advises enterprising investors to evaluate whether the underlying stock is strong enough to justify the added premium of the convertible security. Similarly, stock warrants, long-term options that grant the right to buy shares at a fixed price, should be approached cautiously. Warrants can offer significant upside potential, but they are highly speculative and prone to dramatic price swings. Graham ultimately concludes that while these instruments can be useful in specific situations, they should not form the core of an investor's portfolio. The intelligent investor should treat convertibles and warrants as secondary options rather than primary investment vehicles, ensuring that their portfolio remains grounded in fundamentally sound securities. Next is Chapter 17, for extremely instructive case histories. To illustrate his investment principles, Graham presents 4 real-world case studies of companies that highlight both successful and poor investment decisions. These cases showcase how fundamental analysis can uncover warning signs or opportunities that are often overlooked by the broader market. One case study examines a company that appeared strong on the surface but suffered from hidden financial weaknesses. By dissecting its balance sheet and income statement, Graham reveals how investors who ignored key red flags ended up suffering significant losses. Another example highlights a company that was undervalued due to temporary setbacks, offering enterprising investors a chance to buy at a significant discount before the stock rebounded. Through these instructive examples, Graham reinforces his core message: successful investing is not about following the crowd or making impulsive decisions, but about conducting thorough research and sticking to a disciplined strategy. He demonstrates that by applying fundamental analysis and maintaining a margin of safety, investors can avoid costly mistakes while identifying promising opportunities. These case histories serve as powerful reminders that the principles of value investing, when applied correctly, can lead to long-term success in the stock market. Next is Chapter 18, a comparison of 8 pairs of companies. In this chapter, Graham continues his practical approach by comparing 8 pairs of companies, analyzing their financial stability, valuation, and performance to highlight key differences in investment quality. He demonstrates that businesses with similar market capitalization can have vastly different fundamentals, making it essential for investors to dig deeper into financial statements rather than relying on surface-level comparisons. One of the critical lessons from these comparisons is that a strong brand or reputation does not always equate to a good investment. Graham shows that companies with solid financial footing, low debt, and consistent earnings are often better long-term investments than overhyped businesses trading at unsustainable valuations. The analysis reinforces the importance of scrutinizing companies through objective metrics rather than following market trends or emotional biases. Next is Chapter 19, Shareholders and Management's Dividend Policy. Graham examines the often contentious relationship between shareholders and corporate management, particularly regarding dividend policies. He emphasizes that management should prioritize maximizing shareholder value, and dividends play a crucial role in this process. While some companies reinvest profits for future growth, Graham warns that retaining earnings without clear benefits can be detrimental to investors, especially if management is inefficient in capital allocation. He argues that companies with strong earnings should return a fair portion to shareholders rather than hoarding cash or engaging in reckless expansion. However, he also acknowledges that in some cases, such as rapidly growing businesses, retaining earnings can be justified if the reinvested capital generates high returns. The key takeaway is that investors should evaluate whether a company's dividend policy aligns with its financial health and long-term strategy rather than blindly assuming that higher dividends are always better. Next is Chapter 20, Margin of Safety, as the central concept of investment. In this concluding chapter, Graham drives home the most crucial principle of intelligent investing, the margin of safety. This concept is the foundation of value investing and serves as the best protection against market volatility and investment mistakes. By purchasing stocks at a price significantly below their intrinsic value, investors create a cushion that protects them from unforeseen declines or miscalculations in valuation. Graham likens this principle to engineering safety measures. Just as bridges are built to hold more weight than they will ever bear, investors should buy assets with a buffer that accounts for uncertainties. This margin of safety is what separates investing from speculation, ensuring that even if market conditions worsen, the investment remains fundamentally sound. By adhering to this rule, investors can mitigate risk and increase their chances of long-term success, reinforcing the timeless wisdom that the intelligent investor is patient, disciplined, and always values safety over speculation. Later, financial journalist Jason Zweig provided invaluable commentary, bridging Graham's timeless principles with modern market realities. Zweig's insights bring fresh perspectives to the book, helping contemporary readers apply Graham's methods to a rapidly changing investment landscape. One of the most significant aspects of Zweig's commentary is his discussion on behavioral finance. He highlights how psychological biases, such as overconfidence, herd mentality, and fear of missing out, FOMO, can drive irrational decision-making, leading investors to stray from Graham's disciplined approach. By incorporating examples from more recent financial bubbles, such as the dot-com crash and the 2008 financial crisis, Zweig reinforces the enduring relevance of Graham's teachings, warning that speculation disguised as investment remains a major pitfall. Additionally, the appendices and later editions provide further case studies and practical applications of Graham's philosophy. Readers gain deeper insight into historical market cycles, understanding how investor sentiment can create dangerous bubbles and lucrative opportunities for those who remain rational. These appendices also feature Graham's own lectures and additional writings, offering readers a broader view of his thinking beyond the intelligent investor. Perhaps most crucially, Zweig's work underscores the importance of adapting Graham's principles to modern tools and financial instruments. While Graham focused primarily on individual stock selection, today's investors have access to index funds, ETFs, and other passive investment vehicles that align well with his defensive strategy. Zweig encourages investors to use these tools wisely, maintaining the same emphasis on value, patience, and risk management that Graham championed. Through these extensive commentaries and appendices, the book remains as relevant today as it was when first published. Zweig ensures that new generations of investors can benefit from Graham's wisdom while navigating the complexities of modern markets with confidence. Let's talk about takeaways of this classic book. At the heart of The Intelligent Investor lies a simple yet profound message. Investing should be rational, disciplined, and focused on long-term success rather than short-term speculation. Benjamin Graham provides a roadmap for investors to navigate the unpredictable world of finance with confidence and wisdom. Here are the most powerful takeaways from this classic masterpiece. First and foremost, Graham teaches us that an intelligent investor is not someone who beats the market, but someone who avoids foolish mistakes. The financial world is filled with distractions, temptations, and hype, but the true investor stays grounded, making decisions based on careful analysis rather than emotions. The book emphasizes the importance of value investing, the art of buying stocks for less than their intrinsic worth. This strategy is based on patience, discipline, and the ability to recognize undervalued opportunities when others are blinded by market trends. It is not about chasing quick profits, but rather about making sound investments that will stand the test of time. A key concept Graham introduces is the margin of safety, which serves as a protective buffer against errors in judgment and market volatility. By purchasing assets at a significant discount to their intrinsic value, investors reduce their risk and increase their chances of long-term gains. This principle applies not only to stocks but to all forms of investment, reminding us that security and stability should always come before speculation. Another powerful lesson is the importance of managing emotions in investing. Fear and greed are the biggest enemies of financial success. When markets crash, panic causes people to sell at a loss. When markets soar, greed makes people overpay for stocks that have already risen too high. Graham warns that the intelligent investor must remain calm and rational, seeing market fluctuations as opportunities rather than threats. The book also highlights two distinct approaches to investing. The defensive investor, who prioritizes safety and stability, and the enterprising investor, who is willing to take on more research and effort in search of higher returns. Both strategies can lead to success, but only if applied with discipline and knowledge. Another key takeaway is the importance of diversification. Graham advises investors to spread their investments across different asset classes to reduce risk. No one can predict the future with certainty, but a well-diversified portfolio can withstand market downturns and protect an investor from catastrophic losses. Graham also warns against market speculation. He teaches that just because a stock is popular or has been rising in price does not mean it is a good investment. Investors should focus on fundamentals, financial health, earnings stability, and long-term potential, rather than being swayed by market fads. Finally, the intelligent investor underscores the value of continuous learning. The best investors never stop educating themselves. Markets change, economies shift, and new opportunities emerge. Those who stay informed and adapt while remaining faithful to the core principles of sound investing will ultimately succeed. In summary, Graham's teachings are timeless because they focus not on prediction, but on preparation. He provides the tools and mindset needed to invest wisely, avoid costly mistakes, and build lasting wealth. Whether you are new to investing or a seasoned professional, the lessons from the intelligent investor will guide you toward financial independence with patience, logic, and confidence. If you found this summary insightful and valuable, don't forget to show your support by subscribing to the Mindful Brief on YouTube. Hit the like button if you enjoyed this audiobook summary, share it with your peers who might benefit from it, and leave a comment below with your thoughts. Your engagement helps us create more in-depth and valuable content for you. Stay tuned for more summaries, insights, and strategies to elevate your knowledge and career. Subscribe now and be part of the journey.